Okay, investors, maybe 5 or 10 years from now, we'll look back and cry about the 21 trading days in September of 2025 as the ninth inning of the AI tech stock investment bubble, just like Paul Tudor Jones has recently suggested. Paul Tudor Jones has said that we are in late 1999, replicating near the end of the dot-com bubble. My view is I doubt that will be the case. I doubt we're in the ninth inning, as he suggested, and the party is good enough to hang around, but one should be looking for the exits very quickly. I doubt that's where we are. First off, I don't see the comparison to the third quarters during the 1998 through 2000 dot-com run. The data says otherwise. In fact, the third quarter stock returns was negative in each of those years. In Paul Tudor Jones' analogy, it's early fourth quarter 1999. I can't disagree more. In the summer of 1999, the S&P 500 was down over minus 6.5%, not up over 7.5% like we just were in the third quarter. Here's the seasonal table for the S&P 500 throughout the dot-com internet build-out for you. You can make your own decision. Paul Tudor Jones was one of the best traders in his day. However, I would argue that like most retired billionaire hedge fund managers I've heard on financial TV for well over 5 to 10 years, most of all, their advice has been ill-timed or just flat out wrong. They don't trade the way they used to when they were making their fortunes. If you've been following our videos, we've been discussing the dot-com internet build-out versus AI build-out analogy for well over a year, and our team has been increasingly positive on it since the mid-April stock market V-bottom of this year. Others have been trying to scare you out by a comparison in a negative way about it being a bubble. My question to them is, if you're so good at spotting bubbles, why haven't you been long and investing in it, taking advantage of it, as you're probably equally as good at getting people out on the other side? This might be the 10th video I've done on this subject the last 5 to 6 months. In our work, if you're making this analogy, our April 2025 tariff lows, when the S&P 500 was down minus 21% off its highs, corresponds to the long-term capital management lows in early October of 1998, when the S&P 500 was also down minus 21%. Investors using this as the timing overlay, which has accurately and almost precisely mirrored the dot-com rally, would put you in the early April of 1999, say 3 to 4 more months to go in our initial V-bottom rally to more new all-time highs. You would be in the third or fourth inning of the game, not in the ninth inning looking to run for the exit. Would this make sense now? To me, the answer is yes. No one still gets in. Here's a longer-term overlay and a zoomed-out version of where we could go and where we could be in the future if we continue on this path. What could cause a true parabolic move in stocks farther out next year in 2026? That might mirror the second half of 1999, which was post-seventh inning stretch, into the ultimate top, which was in early first quarter 2000. Well, investors, I'm just guessing, but a new, more dovish Fed chair appointed by the President Trump next April or May would correspond almost exactly to the week when the last leg up on the dot-com run began. Recall the dot-com ran lasted almost exactly 18 months from the long-term capital management bottom in October of 1998 to its top in the first quarter of 2000. But Chris, stocks move on both interest rates and earnings, and 2026 earnings can't support that kind of move is a comment I've heard a lot lately. Well, if you believe the quarterly earnings estimates from Goldman Sachs, it can. Investor, there's a table here from their quarterly S&P 500 earnings growth rates historically and next year for 2026. Investors recall that the overall S&P 500 index historically anticipates economic earnings and bottoms by troughing 1 to 2 quarters in advance of the economy. However, it doesn't anticipate market tops. Historically, the S&P 500 tops coincident with earnings growth rates. It hasn't historically peaked in advance of the economy and in advance of earnings growth. V-bottoms historically do not have extended or deep pullbacks on percent terms until after the 10th or 11th month as you approach a year holding period for those investors who bought and held on for almost a year. That would be a decent top in the first quarter of 2026 at around 7,200. Subsequently, the market would sell off for a few months before putting in a low right around when the new Fed chair is installed, and then take off for the next 4 to 6 months in the summer of next year in 2026. Okay, so what could cause this? My best guess is the new Fed chair would reinstate some form of QE, that's quantitative easing again, or yield curve control. This would suppress bond market volatility, keep interest rates low, and force investors to move their cash off the sidelines finally, and ultimately create a rush into riskier assets using leverage. Of course, all this is just guessing and brainstorming about how the markets could continue to mirror the dot-com boom, but a time earlier in the game and a move when you should be in the markets and still not fearing a bubble or a blow-off top. Investors know that regardless on the path for the economy and the financial markets in the next few months, the investment team at Oak Harvest will be here. Until next week, have a blessed weekend, and know that the Oak Harvest team is doing what we can to plan for you and your family's future, regardless of what stage you're at in your career or in your retirement.